Is this Joe Saluzzi?
You got him, Dennis.
What's going on, buddy? How's it going?
Well, we picked a good week for this, huh?
Oh, yeah, we did. We did. All kinds of news here. Fun market structure talk here. Joe, okay, let's get the Themis thoughts here on, did this guy cause the flash crash?
He contributed to it.
Okay.
Yeah, no doubt. He definitely contributed.
Now, okay, this is where I think there could be a contribution here first, but my whole concern here is, and this is what I was said on the show the other day, is if this market is so flaky that somebody throwing a couple layering orders, and they were significant size, if during the flash crash, literally we had no bids on 300 different stocks. The S&P futures went 10 points wide, and just because there's a few layering orders out there, and it was kind of a perfect storm. It was Greece, there was some other stuff, but isn't that concerning that somebody sitting on their couch at home, like sending a couple fake orders into the market, can cause all the liquidity to suddenly disappear?
Oh, absolutely. And are we really to believe that there's one guy in the world that figured out how to do this? Of all the thousands of traders sitting all around the globe who have access to the E-minis, there's only one guy who said, hey, I can layer out the book and everyone's going to fade the bids? I don't think so. Right, and I really, I keep pointing, I keep looking at the case. Where do you have to point your fingers at the regulators? You have to point your fingers at the exchanges, and you have to point your finger at the brokers who are representing these guys. Those are the lines of defense that the market looks to basically not have situations like this, and they all failed. Every single one of them failed.
Yeah. Why did this take 5 years to come out?
Well, then that's the real story, too. First of all, I'm waiting anxiously for the retraction that the accusation of the Kansas City Mutual Fund caused the flash crash. I would like to have the regulators come out and admit they were wrong and that the Kansas City Mutual Fund, in fact, was the victim. They were not the cause of the flash crash. They were the victim. Their orders were manipulated. Their orders were basically the spoofers moved those orders around. They had legitimate orders to sell, right? Whereas opposed to this guy who had illegitimate orders, allegedly. So the question of why it took 5 years, obviously, I think now a whistleblower, obviously, it seems to be coming forward, and that's the reason why they figured it out. But think about this. The CFTC is on record as saying, we don't look, when we studied the flash crash, we didn't look at orders, we looked at trades. You didn't look at orders. I mean, are you kidding me?
It seems insane. Yeah, because
it took
you
them
think of
5
how many
months.
orders are canceled. Yeah.
That's where the manipulation occurs, and when it's the route of the order and before it gets to its destination, and at least in the equity world, that's what we look at more so, not where we traded the stock, but how the order was getting there and where it was sniffed and how it got pinged along the way. In this situation, it would have been very easy. If this guy was 20 to 29% of the orders on the flash crash day, very easy to pop them and figure them out. I don't understand.
Joe, let me hop in here for a second, okay? Garrett Cook on our desk has been doing a lot of research on this. And supposedly, this guy shut down his system and it was not running. And I think this is courtesy of Eric Huntsader, too, that he had been running the system, but when the actual incident occurred, it wasn't in action.
Yes, and Eric had pointed out also that it was like 2 minutes before the actual, well, although the market was under pressure while that was happening as well. So I don't know the exact timing of it, but what you do know that he was involved. This guy was involved that day. But let's be real here. Like you said before, are they scapegoating one guy? This was obviously illegal behavior. Okay, if they prove it. So yeah. But, I mean, are they scared? We have a poor market structure. Okay?
Yes.
We have poor regulatory surveillance systems. That's the real story. The real story is how this could occur in the first place. Because, like we just said, it could be 5 or 10 other guys out there. So, and then there's one argument that's going around that some folks are making that spoofing is good. I mean, really, guys? Are you condoning illegal behavior? It makes absolutely no sense to me. If you're putting in an order and it's an illegal order, and spoofing by definition under Dodd-Frank Section 747 is illegal, then it doesn't belong in the marketplace, period.
Yeah, it doesn't belong to try to trick other people into thinking there's a buyer in the market, so your day trader or your short-term high-frequency trader is going to jump in here ahead of it. It seems ridiculous to say that should be a legal activity, but I'm still, my concern goes back to the same thing, and you've mentioned this here before, Joe, too, is that the liquidity is just it scatters so easily, it seems like, and maybe we haven't seen that in the last 5 years because we're in this bull market here, and 99% of the time the liquidity is fine, but that 1% of the time where you get this perfect storm scenario where we had some concerns, and this was Greece concerns here 5 years ago. We're talking about Greece for 5 years, but Greece here concerns was really why we were down 200 or 300 points as some of this, earlier in that day on May 6, 2010, as this, layering was occurring as well. So maybe, Greece contributing to it, maybe a little bit of this layering contributing to it. But all of a sudden, all of your bids pull out on 300 stocks and there's no bids at all in the book. How does liquidity all just disappear?
It's unbelievable. But let me give you one other thing. And we all remember this real well back in 07, 08, 09 during the financial crisis when the Dow Jones was going down 700 points a day and then bouncing back up on every headline, and some reporter said that somebody was getting a bailout or whatever it was. We had enormous volatilities those days. Are you telling me that this fellow or maybe somebody else at the time wasn't doing the exact same thing back in those days? Did anybody investigate during the financial crisis? Was there spoofing? We had the same market structure back then as we do now, a fragmented mess in the equity market. We had futures trading electronically. I have a feeling, my gut says that the same thing was going on. And a lot of people lost a lot of money back then. And unfortunately, a lot of people never came back to the market because they were their confidence was shattered by those events and the volatility moves. And they never got back in, so they lost money on the way back up. So I would like to know, during the financial crisis, were spoofing algorithms going as well? And has anyone caught them?
I think this stuff is very prevalent here in the market. I think it's commonplace. I think whoever's spoofing right now is obviously going to be backing off on the spoofing tactics. But I think it's something that's honestly gone on the market for a long time. I think this is, Joel, you were even talking back on the floor. It was types of spoofing where, what would happen in the pit? Joel, take us to the pit.
Yeah.
Would you see this type of stuff action happening in the pit?
And it's very similar to
would
this.
You?
Yeah, of course you would. And it's
how is it dealt with though? Like, cause I'm just thinking, this is the difference here. Because when you're in a pit and you have some trader throwing up fake orders there, it's going to kind of self-police itself, is it not? Like,
exactly.
Isn't the other traders in the pit going to say, this guy's a liar, or this guy, is throwing out fake orders here, I'm not believing anything he's saying, and then nobody's obviously going to take anything he says with credibility. When you're behind a computer screen, though, and nobody knows who you are, that's just kind of free game here because it can't self-police itself.
Yeah, and it's I'll just give you a situation. Let's say it's even bid and there's a big bid and it gets taken out, okay? And we'll just go example for the S&Ps, trading on the E-minis, and it goes heavily offered at 75, okay? And a big trader who's short, just as the evens are going at 75 offer, he'll go 5,000 at even. Well, the even's already traded, buddy, and now it's 75 offer, and everyone will go, ooh, they self-police. Everyone will go, ooh, you're offering evens now, and it's 75 offer. So
nobody's really taking that big order. They know that's not basically real.
But Dennis and Joel, you had people there to monitor it, like Dennis said. That now what we rely on are our regulators to monitor, because we're in an anonymous world where people enter and exit positions in microseconds. The only line of defense right now are the regulators and the exchanges, and they are not doing their job. I wonder about the exchanges and their for-profit mentality now, and how their bread is buttered. Are they really aggressively pursuing these guys? Are they spending enough money on surveillance systems? Are the regulators being danced around in some other direction by others? It doesn't make it doesn't make me feel comfortable that someone's got our back, as opposed to what you were saying, Joel, on the floor. And I spoke to a floor trader the other day. He goes, if we tried that in the old days on the 90s, not only wouldn't I be allowed to trade, he goes, they take me out back and kick my what? It's not that way anymore. So who are we relying on? And then the CFTC comes out and says, oh, we don't have the budget for this. And I agree, they don't have the budget for it. They're a $280-some-odd million organization, trying to monitor this market. So someone's got to figure out a way to pay for surveillance systems. One of the suggestions we had was all the fines that they send out and they're getting lately from some of these rogue organizations, why not take a piece of the money from the fines and establish a real surveillance system, whether or not you have to subcontract it or not. And now you've got a payment mechanism to pay for that surveillance system, which is kind of a self-fulfilling prophecy, because at that point, once the bad guys know you're watching, they're not going to do it. But as of now, they know you're not watching, so they're going to keep doing it.
What if there's people doing this in countries where you can't get extradited from too? Like, what's stopping somebody from sitting over in a country that they're safe to do this from? And
but at least you can shut them down. Right?
Like,
at least you shut them down when they're doing it. You shut up their account. But you're right. You can't police someone out in I don't know where. Pick a spot out.
Some small little country where you can't get extradited or where you're safe. Like that could be happening right now as we
Absolutely.
speak.
But that's the broker's responsibility. You have to know your client as well. And if you've got a guy and there's all sorts of checks and balances you have to do, and that's the first line of defense is really the broker. If the broker sees orders coming through like that, they have to alert authorities. They have to alert their compliance
Or
department.
flag it or something.
There's a lot of people who did not do their job in this situation. So the media loves saying, "Oh, the flash crash was caused by a guy in the UK." That's not the story. Okay, the story is a failure of surveillance and a failure of a market structure that allowed this to occur. That, as you just said, can occur anytime, anywhere in the world. Does everyone feel safe that it's not going to happen today or tomorrow? Eric keeps showing more spoofing. Eric Hunstetter keeps showing more spoofing algorithms that went on yesterday. It's continuing. So,
there could be hundreds of traders doing this stuff every day. Like you see it in the small caps too, like because those stocks can really be manipulated where somebody throw out a big offer there. And I like to see it sometimes when I'm trading these things. I'm like, no way is that thing real. And you see it, come out and the stock will sell off a little bit. And then it cancels and then, they're scrambling. But they are trying to manipulate the algorithmic traders there a little bit there. So because I think the humans are sometimes smart enough to realize that this isn't real, but I think sometimes the machines aren't that smart.
Well, right, and that's the vigilantism, I guess, that people say that spoofing causes. Well, it's a good thing. Well, unfortunately, some of the algorithms are actually run by real institutional traders who maybe not have a sophisticated algorithm as, let's say, a proprietary trader, and they get caught up in this. But you're right. And then it's their fault. They have to monitor it. They have to be careful. They shouldn't be getting caught by a spoofer. But look, bottom line is, again, you have to feel comfortable that someone's watching your back here.
Joe, I want to move on a little bit here, and I want to know if you're a buyer of Virtue Financial Incorporated. VIRT delayed the IPO because of Mr. Lewis being on 60 Minutes in his book. Stock's IPO, not even a week old. Buy, sell, or hold on Virtue Financial.
Joel, I can't answer the question because as an agency trader...
Okay, I'm sorry.
We want to held you to it.
Sorry, Joe.
I can't. Otherwise, I'd get in trouble here if I'm talking about specific stocks. But look, they have an interesting business model. I read the S1. I think it's very interesting. Interesting how they spread out their revenue streams. I'll let the market decide what they think of it, but...
Okay, all right. But Dennis and I have been debating about it too.
My only concern is, and we're just talking about the high frequency trading industry in general, is obviously, they have, there's the edge on speed and different things. If regulation was to come in on some different types, I'm not saying it's going to, but I guess that would be a risk if you were, looking at, buying this thing as an investment. If regulation suddenly changed or market structure slightly changed, there could be an adjustment phase, or potentially maybe they couldn't adjust to it, and then if the speed was regulated, for instance, that would be the risk, right, Joe?
Well, and I think there's also one of the risks is that the margins have collapsed in the HFT world. There has been a lot of competition. So if what you're saying, like say there is a new regulation that comes through that ends up costing these folks money, maybe now that they have to register for FINRA, they have to set up some new systems, that could start to eat into some of the profit margins across the board, or across any HFT or proprietary trade, and then maybe that make it doesn't worthwhile. I would think that would affect the smaller ones more, and because then you have to spend more money on surveillance systems and other things. So that's one to watch. I think you have to watch these new FINRA proposals that are out there. They did propose everyone register for FINRA, but there was another proposal which kind of snuck in saying that they would exempt proprietary traders from the so-called TAF fees, or the trading activity fees. So there's all sorts of little things you have to be careful when you say one thing, it's going to increase regulatory costs, but meanwhile there's a footnote that says if you're a prop trader, you don't have to pay it.
Sticking with this HFT theme here, I asked Dennis the other day if he had any updates on the IEX, the new budding exchange. I know you talked kind of favorably about it. How's the volume? Is it increasing in that exchange? Is it getting to be where? Okay, go ahead. Give us a little update on that.
They have actually just unveiled they're displaying quotes, basically. It's not part of it's not a protected quote. But anyway, starting April 1st, they did that. Their market share went from 1 to 1.3%. So they're starting to get bigger, yeah. And I think what's happening is the routers, the broker routers that are out there, and the smart order routers are interacting with that visible liquidity, and it's actually touching their book even more. So they're still doing well. Their goal is to become an exchange, and that's right now they're in the process of trying to become an exchange. And in the meantime, they rolled out this layer of displayed quotes, which is very interesting. But our experience, I could speak firsthand, has been very favorable. It hasn't changed since the last time we spoke. The chunkiest fills that we get are on IEX. The least amount of movement that I get when I'm trading is when I'm on IEX. I don't get the wiggle. I don't get the noise that I do when I'm either on another lit venue or even in some dark pools that we think are filled with lots of ping destiny, ping predators and whatever, and different IOIs that are going on there. But I have to still say, I don't work for IEX. I don't have any stock in IEX, but they are a solid company.
Just one follow-up on that. The displayed liquidity, is it, what kind of, let's take some of these, I don't want to go like a G or a Bank America or something like that because they're really thick stocks. But, some of these higher $50, $60, $70, $80 stocks, what kind of spread are you getting and what kind of displayed liquidity are you getting? Are you getting this 100 share stuff or are you seeing some size out there?
Well, I don't think you're not going to see size. I think because you could also have reserve book orders or iceberg orders, right? So you can see 200 shares, but it is showing that there is something going on there, which sometimes it's just enough for someone to say, okay, I'll dip in with 500 and see if there's more, and then they get more, and then they don't get the movement that they do when they go into, let's just say, say for instance, a lit venue, an exchange has 100 shares, and you go out and you try to sell it to them. As soon as you sell the 100, it's gone, even if there was more behind, unless you dipped in with more. Where with IEX, you're not getting that movement right now, and it's still early in the game with what they've done. But I don't think you're going to see size because if you see size, people are going to run ahead of it still.
And that's the whole thing here. That's why, layering is actually maybe more effective today than it was 10 years ago because nobody shows size anymore. So if you see size out there, everybody does trade ahead of it there. So that would be my argument as why layering, why these tactics here, why this guy can make $40 million in the last 5 years, because it's much more effective probably than it was 10 years ago when everybody was showing size.
Right, and that's a failure of market structure. Again, I would continue to say when you have a fragmented market with all these destinations, you're not bucketing liquidity, you're fragmenting liquidity, you're spraying it out on all these destinations. So yeah, you're right. Then all of a sudden someone comes along with something chunky. Instead, why don't we start to defragment, try to bucket, not one exchange, I'm not saying one, but bucket liquidity, and then maybe you start to see some chunkier sizes, below the bid and the offer and so on, and you say, hey, real limit order books, which of course back in the flash crash didn't exist, right? That's why they just evaporated like that. But that's what makes a robust market when you have all different players, institutional, retail, prop traders, HFT, I don't care who, displaying real limit orders, right? We'd love to get back to that point. And you can still have electronics. There's nothing wrong with that.
Interesting that you bring that up because Bats came out with an exclusive listing proposal there. I haven't seen the actual proposal, but a letter that they intend to come up with this exclusive listing proposal where they're going to back off quoting on some of these small cap stocks. What are your thoughts here on this? Is this the right way to go? And why would Bats do that? Why would Bats want to, back off on potentially participating in some of these small cap stocks?
Well, they don't list, which is interesting right now, right? So, but I think it's an interesting proposal. Yeah. I think there's two problems I have with it. One is that it's trying to negate the tick size pilot before the tick size pilot even starts. In my opinion, it's saying, hey, we have a better alternative, and we can do this. It's much simpler. And just by looking at it, it actually is a very interesting program. However, I would include one feature which they didn't include. I would put a trade ad on there, okay? Because what they're doing is they're saying, okay, here's an exclusive listing. You can only trade on this exchange, but you can trade anywhere else. You can internalize it. You can trade in the dark. What do you think is going to happen? Okay,
I know
it's going to spray out again. So if the BATS proposal had a trade act component with maybe just a midpoint exemption where you can trade in the dark and the midpoint, then I like it actually. Then I think it's very creative and only for the extremely small companies. And let's give it a trial, But it doesn't have that right now.
Joe Saluzzi, partner and co-founder of Themis Trading, giving about an expert outlook on high-frequency trading as you can get. Two experts on, Dennis and Joe. Joe, thanks a lot for coming on. Always entertaining. We hope to speak to you again soon.
Thanks, Dennis and Joe. Great to talk to you guys.
Joe, thanks a lot.